How do you identify a good company? My name is Gary Mashers. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I get this question asked a lot. How do you tell if a business is a good business, or how do you identify a good company? And this video is going to cover this in depth, and I'm going to give you some examples and some counter examples. So make sure to stay till the end, and hopefully you'll get a lot out of it. So before I proceed, I want to make a distinction. What I'm not talking about is a good stock. And just to be clear, you can have a very good company, and that might not be a good stock. You might say, well, how could that be, right? Well, think of it. Think of your favorite company, and imagine its share price goes to $1 billion per share, or $1 trillion per share, or some really large number. So hopefully you would agree that at that price, even your favorite company is probably not a good investment. And that's the point. I won't belabor this point further, but I want to make sure that you guys understand that I'm not talking about, a good stock in this video, talking about a component of finding potentially good stocks, which is identifying a good company. Now, there are two ways to think about what a good company is. And one of those ways is purely qualitative. And that's thinking about industry structure like Porter Five Forces analysis, analyzing a company's competitive advantage, really measuring up its management team and their capital allocation skill and operating ability. Those are super important. But again, that's not what this video is about. This video is about the second way, and it's looking at financial statements and looking quantitatively at a company and identifying what characteristics should a good company possess. Now, in the ideal world, you would marry the two approaches. You would take the qualitative approach as I described with the quantitative approach I'm going to teach you in this video, and the two work together, right? So it's not that you just do one or the other, but I want to kind of focus what the video is going to be about and what it's not. All right, so I'm going to share the screen, and I'm going to start with defining some terms just so we're all on the same page, and we'll dive in. So bear with me for 1 second. Let me share the screen here. Hopefully you guys can see it. And so we're going to talk about good company. And first, some definitions. And I'm going to go through these quickly. You can stop the video if you want to think about them some more, or you can look them up, or just reach out to me if something is unclear. But let's start with the basics. So EBITDA is earnings before interest, taxes, and amortization. Now, the reason I'm using EBITDA as opposed to EBIT or EBITDA is that depreciation tends to be a real economic expense. However, amortization in many cases is not. It usually doesn't have a future cash outlay associated with it. That's why I'm starting with EBITDA. NOPAT, which is net operating income after tax, is simply EBITDA times 1 minus the tax rate. So going along here, invested capital is debt plus equity, just to keep it simple. Return on invested capital, or ROIC, is NOPAT divided by invested capital. And WACC is the weighted average cost of capital, which is cost of debt multiplied by the percentage of capital that comes from debt, plus cost of equity multiplied by the percentage of capital that comes from equity. Now, getting to the more interesting stuff, we have economic profit, which I'm defining as return on invested capital minus WACC, or weighted average cost of capital, multiplied by invested capital. So think about this as the margin of victory the company has had over its opportunity cost, multiplied by how much capital it can deploy at that margin of victory. Because if a company is not earning its cost of capital, then it's really not doing anything useful from kind of an investment point of view, at least from a long-term point of view. There might be times when it's not earning its cost of capital. By the way, I really do believe that this metric is superior than looking at just return on invested capital, because essentially you can think of it this way. You could have a company with, 100% return on invested capital, and you can say, wow, that's an amazing company. That's the best company ever. But what if it's only able to deploy, $1 million at that rate of return, versus you have another company that can deploy, $20 billion at 30% return on invested capital. The second company is going to have a much higher economic profit, even though its ROIC would be lower than the first company. So just keep that in mind. Moving on, so FCF, or free cash flow, is cash flow from operations less maintenance capital expenditures. And sometimes it's hard to tell what maintenance really is. So I think usually we start with just CFO minus CapEx. But I think you really do, if there's a big difference, want to dive in and understand what's maintenance versus what's growth capital expenditures. So what characteristics should a good company have? Well, three characteristics, I would argue. One is increasing economic profits. So if the company has positive economic profits, but they're not growing, it's not a bad business. I think it's a decent or good business, but it's not one of the better businesses out there. For that, you really want economic profits to keep increasing. Second, you want to have rising free cash flow. And third, you want to have free cash flow that over time, on average, is not much below net income. 70% or 80% is fine, but if it's 30%, you have to really dig in and understand why and make sure that that's appropriate and it's not some issue that you're missing. Now, what are some exceptions? Because obviously, if you go back for a second, if you always insist on these three characteristics, you're going to miss some companies. You're going to make a kind of type 2 error or an error of omission. So the exceptions, you have companies that might be running substantial investments, such as say subscriber acquisition costs through their P&Ls, and that distorts the P&L, makes it look like it's not earning its cost of capital. So that's possible. You can also have just early stage companies that are really good, but they're subscale. Let's say a retailer with a really good unit economics, but that's unfortunately just it doesn't have enough units yet to offset the central corporate costs that are weighing down the returns. So those are two examples, and I'm sure there might be others. But this is not a perfect tool, but I would say more often than not, my guess is 80% plus. I know for a good company to really be a good company, it needs to have these characteristics over time. And by the way, I mean maybe I should say very good, because you can have a good company that's kind of stagnant and it's earning a nice return on capital, but it's not able to deploy more capital, at that return, and it's kind of just dividending out its free cash flow. And that can certainly be a solid, good business. But I'm talking about some of the best businesses out there, once they're able to actually increase their economic profits and free cash flow over time. Okay, so let's dive into some examples. Bear with me, I'm gonna switch to my Excel here and share that with you. So this is a template I built, and it's going to be a little slow at times loading, but basically it pulls data from Bloomberg and automatically populates these two charts, which I'll explain in a second. So the leftmost chart, which is the free cash flow chart, the blue bars are free cash flow in each year on the left axis. The red line right here is the percentage that free cash flow makes up of net income on average over the last 10 years, and it's on the right axis. So the way to interpret it for this company, which is Ecolab, is that this company had high 70% free cash flow percentage of net income, and it has positive and rising free cash flow over time. The right box over here, the right chart, is economic profits, the way we just defined earlier. And you can see that Ecolab has had positive and rising free cash flow generally. And there were some years where maybe there was something happened, maybe an acquisition or a big investment, or maybe a lull on demand. But basically, by and large, on a rolling every few years, economic profits are much higher. Let me show you a couple of other companies. So I'm going to punch in O'Reilly Automotive, and you can see that it takes a few seconds for the data to populate as the Excel is pulling the data. So here's O'Reilly Automotive, and you can see very similar characteristics: positive and rising free cash flow around 100% of net income, and nicely increasing economic profits over many years. So very pretty chart. That's kind of what you want to see. Let me show you one more example, and I'll give you after that some counter examples. So this is going to be Robert Half International, and when it loads, what you'll see is that it has those characteristics we talked about, but there's one wrinkle, which is that it has periods when it actually has negative economic profits. And you might say, why? Well, this is a cyclical business. And I think there's some misunderstanding out there. There's some investors, including some experienced investors, who basically think that a cyclical business cannot be a good company. And that's wrong. That's just flat out wrong. Because what you care about is the economics over a long period of time. And you can totally have a cyclical business that has short periods of adversity followed by long periods of prosperity. And over time, the total economics over, say, a 10-year period or a longer period are very attractive. And that's what you have here. You can see in every cycle, you're reaching higher and higher levels of economic profit, right? And even if you were just think about area under the curve, as opposed to just the highest point, that's increasing as well. So again, it's punctuated by some unfortunate, kind of cyclical events, but that doesn't make it not a good company. So those are three examples. Let me give you a couple of counterexamples. The first one might be a company you have probably all have heard of, AT&T. And Because you might think, well, any blue chip company is going to have this kind of, financial characteristics, and that's not the case. So here you do have rising free cash flow and good free cash flow conversion for AT&T, but you can see that economic profits have been stagnant and actually negative in a number of years. So you definitely don't have this rising economic profits. As a matter of fact, economic profits for AT&T are not that different than they were 10 and 20 years ago. So that's not a great outcome. It certainly doesn't qualify based on our definition. Let me give you one more, which is Royal Caribbean, which is a cruise line company, which you might have heard of. And, again, it would certainly be considered quote, a blue chip company, well-known brand, and so forth. But look at this. First of all, you have negative free cash flow in most years, which partially is explained by the fact that some of the capex is growth capex. But even putting that aside for a second, you can see that most years economic profit is actually negative. And forget the COVID year last year, that's the big negative bar here. But most other years, other than some peaks of the cycle, they're not earning their cost of capital. So another way to interpret it is that they're spending so much on the ships, and they're not earning enough from this tickets and ancillary revenue from cruising, that they're not meeting the cost of capital. So their shareholders in some way might be better off if they stop building ships. Yeah, not telling them what to do. I'm just saying purely financially that might be the case, unless the math changes. So that's a couple of counterexamples. So I hope this has been helpful to you. Again, to put this into context, this is a tool. This is a tool where if you incorporate it as a part of your process, that can help you either verify or validate whether the company you're looking at is indeed a good company, or you can use it to find good companies. So, for example, over the last few weeks, I went through the 3,000 largest companies in the US, and I pulled up these charts for every single company. And I came up with a list of companies that had the characteristics I described. And interestingly enough, it's about 10% of those 3,000 companies, right around there, right around 300, that fit these criteria. So it's not like these are impossible criteria to find, but it's a small minority. 10% is certainly far less than half, and that's fine. I'm a concentrated value investor, and I'm not looking necessarily to, have hundreds of investments. But it's good to have a list of companies that I know have these characteristics, and then hopefully combined with qualitative analysis and a lot of other research, they could potentially end up being investments at the right price in the future. Very well. I hope this has been helpful to you. If it has, please hit like, subscribe, and I will see you in the next video. Thank you.